All right, thank you so much for attending. My name is Michael Smith. I appreciate the entire Cockerell team for having me on the presentation. I will be presenting today on the business and the banking basics for physicians that are looking to get into private practice. So first, I'm going to do an introduction to myself and a little bit of background on our team at Bank of America and what we do, and then I'll start to get into some of the stuff that we're going to talk about today. So first, a little bit about Bank of America. So Bank of America Practice Solutions, we are a specialized division within Bank of America that only works with doctors on practice financing. So myself and our entire team of underwriters and closing coordinators and project managers are all working with doctors like you that are looking to start their very first practice, to buy into a practice or purchase a practice and purchase real estate or expand. Pretty much anything that you would need when it comes to practice financing, that's what we do. We are endorsed by a couple of big organizations in the medical community. We're endorsed by the AOA, we're the AAD, ASPS, and many others. We are one of the only banks that have been doing this for 20 plus years, and we're the largest in the industry. We've been doing this for 25 years exactly. Last year in 2023, across all of our divisions, we have a medical division, we have a dental division, and a veterinary division. We financed over $2 billion to doctors in private practice, which is amazing. So although we do see private equity and corporate in healthcare, there is still a lot of doctors that are wanting to go out on their own and stay in private. So that's what we're here to do to support. In those past 25 years, over the last 9 years, we are the Townie Choice Award winner for the best practice financing bank in the country. So we're really proud of that award. We try to make the process as easy as possible for you. And on top of that, we do have you being a business banking customer, you will have access to over 3,800 financial centers throughout the US, which is the second largest bank in the country and the fifth largest bank in the world. So a little bit about me. So again, my name is Michael Smith. I'm the regional sales manager of our medical department. I've been with Practice Solutions for over 6 years now, two-time Pinnacle Award winner, which is a bank award that we have. And I have funded myself over $200 million in loans for doctors in private practice. So I'm an expert in the field. I'll be able to answer any questions you have and provide as much information as possible. So what kind of loans do we do? So like I said, we basically try to offer any type of financing that you would need when it comes to a practice. So we offer practice startups, practice purchases, including buy-ins or buyouts, office expansions and relocations, debt consolidation or refinances, commercial real estate purchases, and equipment financing. So essentially anything that you would need, that's what we're here for. So what I wanted to do first before I get into it is just show a couple of doctors that we've recently worked with, show some of the loans that we're able to provide for them, and just kind of show you some of the success stories that we've had. So Dr. Ukray purchased his very first practice and the real estate, and he was in Camden, New York. That was his very first practice. He's been licensed for, I believe it was 5 years. And then we have Dr. Dennis. She did a practice cold start or startup in Sparks, Nevada. She was very excited to open up her very first practice. We opened up hers a couple months ago. And then we have Dr. McBride. She purchased her very first practice in Oregon. So we cover the entire country. As long as you are a licensed MD, DO, or any type of licensed doctor, and your specialties that we cover, then we basically offer financing for you. So let's talk about the agenda. So a couple of things I want to talk about today. So first, we're going to cover the common misconceptions when it comes to qualifying for a business loan, because there's a lot of misconceptions out there. We're going to talk about the first-time practice owner profile, what that looks like for a doctor that's looking for their very first loan, what type of debts do they have, what type of finances should they have in place. Then we're going to talk about what debt service coverage is, basically how a bank is going to help qualify you for a loan. Then we are going to look at the different loan structures between a startup loan, what that looks like versus a practice purchase loan, because they are structured a little bit differently. And then we are going to talk about what the difference is between an SBA loan is versus a conventional loan. And then finally, we're going to talk about real estate and what type of options you would have when it comes to purchasing real estate. So first, let's talk about common misconceptions when it comes to a business qualifying for a business loan. So first one we see student loans. I have too much student loan balance. I will never qualify for a loan. This is basically we understand that doctors are going to have student loans. We understand they're going to have a mortgage, things like that. So this is definitely not a deterrent for why you would qualify for a loan or not. We just accept the fact that you are going to have loans, and we just account for that payment. So I'll go into that a little bit more in the next slide. But next is the high fees and interests. So especially nowadays, the residential mortgage rates are really high. I'll wait until the rates go to 3% again. COVID was a pretty crazy time. The rates were in 2 to 3% range. I don't think we're ever going to see that again. I would say a traditional business bank loan that you would qualify for is usually in the 5 to 7% range. So we are on that higher end right now, but I don't know. No one really knows when the rates are going to go down. If they tell you they do, they're lying because nobody knows. And I would hesitate to wait until they go down to 3% or 4% again, because I don't think that's going to happen anytime soon. So, one thing that you can always think about when you're looking to qualify for a business loan or a mortgage is, the amount of the loan can never change unless you pay it down, but the interest rate could always change. So you could always look at refinancing down the line. So if you're looking to purchase a practice or do a startup, although the rates are high right now, you could always look to refinance that loan later if the rates were to drop in the future. The third thing is the household debt. So my spouse and I have too much debt. I hear qualifying for a cold start or startup loan is hard. It really would just depend on the amount of debt that you have and what type of specialist you are. Because we at Practice Solutions, we have a projection built out for 36 different specialties that we cover in our startup platform. So basically, when we look at a new business that's starting from scratch, we're going to anticipate what your revenues and your profits are going to look like in your first 4 years of business. And even though you might have high debt, depending on your specialty in our projections, it could still work number-wise. So I would hesitate to not apply because you think your debt is too high. That may be the case, it may not be the case, but definitely talk to myself or a banker to maybe look at doing like a pre-qualification first. Last thing, oops, I skipped one. It's credit score. So I don't have an 800 credit score, I'll never qualify. Although credit score does play a factor in some cases, it really doesn't have a huge impact. Ultimately, as long as you don't have anything derogatory like a bankruptcy or late payments or short sale, your credit score doesn't play a huge factor in qualifying for the loan. It is something that we look at, but it's not really something that is going to, necessarily say yes or no if there's nothing derogatory on the credit score. The last thing is the collateral. So I hear a lot of times, I must give up my personal residence as collateral to qualify for the loan. This may be the case in some specific scenarios, but generally speaking, when you're getting a conventional loan that's directly from the bank, the only collateral that we take on the loan is the practice itself. So we generally don't take other assets outside of the practice as collateral on the loan. So we don't take liens against your residence or your personal property or anything like that. Okay. So let's look at a profile of what our typical first-time doctor practice owner is going to look like. So there's 5 different things that we generally look at when it comes to looking at a doctor for qualifying. So first thing is going to be student loans. So typically, what we typically want you to see is $500,000 or less in student loans. We want to see you on some type of repayment program, whether it be on standard payments or IBR or SAVE. This could be federal or private loans, and it could be short-term. We're going to look at both the short-term and the long-term payments. So for example, if you're on IBR or the SAVE program and you're making a certain amount of money as an associate at a practice right now, and you're looking to purchase a practice and your income is going to go up, we're going to look at both what the payment is currently, as well as what the payment is going to be once you take over the practice or you make more income in the future. But generally speaking, student loans are totally acceptable. This is not going to be a deterrent for you to qualify for the loan. We just need to understand what the balance is, what the payment structure looks like, and what the short and long-term payments are going to look like. So next is we're going to look at your personal debt. So we are going to look for mortgage payments. We're going to look for car payments, your credit card balances, your rental properties, your student loan payments, your child support or alimony. basically anything that you're paying on monthly, that's basically what we're going to look at and assess. Generally speaking, we're going to go into it after this slide, but when it comes to the total calculation of what you're making in the practice versus what your debt is, if you have all of this debt, as long as the practice that you're purchasing or starting up can support all of this debt, then ultimately that's kind of what the bank wants to see. They want to see your debt to income ratio. They want to see to make sure that you have enough income to support your debt. So if you have a mortgage payment, if you have a car payment, if you have student loans, that's not an issue as long as the practice that you're buying or starting up can support that debt with the income that you're making. Third thing we're going to look at is your earnings history. So typically, as a rule of thumb, this can vary depending on the specialties. We want to see at least 100,000 or more in salary. Outside income is not factored into that. So generally, if you have a side business or you're doing something outside of just the private practice work, we don't want that to be factored into your total income. We want to look at just your income that you're making as a doctor. Typically, we want to see 2+ years of time license, or if you're in a residency program, we want to see at least 2 years. You could be an associate in a practice, or you could be subleasing in another practice, and you could be working in corporate or private practice. This is all acceptable. We just want to see that you have enough of an earning history to show that you're not fresh out of school or you have no experience and you're trying to start a business, because we know that being a doctor by itself is going to be hard, and being a business owner at the same time is going to be even harder. So we want to see that you have a couple years of experience to get your feet wet and be a doctor first. Fourth thing we're going to look at is your work history. So like I said, we want to see at least 2 years of time licensed. Again, it could be an associate at a private practice or corporate, or you could be subleasing. One thing to keep track of, if you're able to, is your production capabilities and what your procedure capabilities and specialties are. When it comes to buying a practice specifically, production capability is important, because if you are looking to purchase let's just say $1 million practice, and the doctor that's working in that practice is doing all the production himself, we want to see that you're able to show that in your past, you were able to produce at that level or more. That way, if we see that you're taking over that practice, you've shown history that you're able to produce at that level that the doctor's currently doing. Could be a little bit different if you're looking to buy into a larger practice with multiple doctors or buying in or anything like that. But generally speaking, if you're able to get with your employer and see if you can track your production on a monthly basis or a yearly basis, and that's going to help you qualify for loans. And then another thing that helps in this scenario is, especially in a practice purchase or a buy-in scenario, if you're already familiar with the practice you're purchasing, if you already have some work history in the practice, you're familiar with the staff and the patients, that's also a benefit when it comes to underwriting these loans. And then the last thing is personal savings. So when I'm talking about savings, this is net liquidity, meaning what you have in your checking, savings, anything liquid account that's not retirement after your credit card debt. So for example, if you have $50,000 in your checking and savings in like your brokerage investment account, and you have $25,000 of credit card debt, in the bank's eyes, you have $25,000 of net cash. So when we're talking net liquidity, this is how much you have after any credit card debt. Ideally, there's none, but if there is some, we'll minus that out of your net liquidity. So we want to make sure that you have enough of an emergency fund to cover both your personal and your business side for 2 to 3 months. So a rule of thumb for when it comes to startups, as a minimum, we want to see at least $25,000 in your savings account. If you are licensed as a licensed doctor for a couple of years, a good way to think about it is at least $15,000 of money saved per year that you've been licensed. So if you've been licensed for 3 years, $45,000 is kind of a good marker to aim for. And then when it comes to purchasing a practice or purchasing real estate, 7 to 10% of the potential loan amount is what we would expect you to have as your emergency fund for business and personal. So if you're looking to buy $1 million practice and you're looking for $1 million loan, we want you to have anywhere between $70,000 to $100,000 in your liquid cash. So again, brokerage investment accounts, anything non-retirement that's considered cash. Unfortunately, crypto is not covered, but checking, savings, anything like that. Okay, so that's basically the basics of a profile of what we typically see when it comes to a doctor buying or starting their first practice. So let's talk about it. Let's just say all of that stuff we're aware of, you hit all those markers. So the next thing we look at when it comes to qualifying for a loan is the debt service coverage ratio, or your debt to income ratio. And basically what the debt service coverage ratio is a measure of the available cash that you have to pay your debt obligations. So I have an example here. So let's say you are looking to purchase a practice, and we're looking at the financials. We see the revenues and the profits that this practice is going to make you as an owner is $240,000. Okay, that's your income that you're going to be making from this practice once you're an owner. Then we're going to look at your debts. So we're going to look at your business debt. So what this business loan payment is going to cost you. We're going to look at your personal debt payments. So like we talked about, so your student loans, your mortgage, your car payments. We're going to calculate what your taxes are, and we're going to calculate what your living expenses are. And let's say after all of that's added up, your annual total debt is $200,000. That means that your debt to income ratio, your debt service coverage ratio is 1.2. So that means for every dollar of total debt that you have, you're bringing in $1.20 in profit or more. So that's the standard, the total ratio that we want you to be at. We want you to be at that 1.2 ratio or more. So, and if you're like, okay, well, I have a lot of debt, so this middle column is going to be over that 200,000. That means in order to qualify for a loan, you have to find a practice that's going to be bringing in more than 240,000 to get to this 1.2 ratio. Or like if the practice that you're looking at for buying into is not going to be making you 240, then your total living expenses and your total debt has to be below the 200 to get to that 1.2 ratio. So when it comes to like buying a practice or starting a practice, it really just depends on the marriage between the two. So that's why we say it's okay if you have all the debt we talked about. It just depends on how much money you're going to be bringing in as an owner of the practice. And one thing when it comes to your debt to income ratio is if you have a spouse that's also working, and maybe you guys are sharing all of your personal debt expenses like your mortgage payment, your car payments, if they're going to be signing on the loan with you as a guarantor, then we can include their income in this left column here together with the practice. So if your spouse is making $100,000 and the practice is going to be bringing in $200,000, then together you guys will be, your total income would be $300,000 if they're on the loan with you. So just keep that in mind. So let's look at a couple different structures. I want to show you a structure of what a typical startup loan with us looks like, and what a typical practice purchase loan looks like. So a typical startup loan. So typically we can go anywhere between 10 to 15 years on your term. This is going to be a fixed rate. So there's no variable rates with us. It's going to be a fixed rate for the entire term, and it's going to be a fixed term. So there's no balloon payments or anything like that. And typically we have 3 years of graduated payments. So your first 36 months of the loan, you're going to have a graduated payment structure. So as you see here, your first 18 months, for example, will be $1,000. Then it goes up to $2,000 after the next 12 months, $3,000, and then your final set payments for the remainder of the loan will be $4,000. And the reason we do that for startups is because we know it's going to take you a couple of years to kind of ramp up your production, ramp up your patients, and start to bringing in a good amount of money in that practice. So we want to make sure that you don't have such a large loan payment that's due on your loan in the first couple of years of your ramp up period. So this would be a typical startup loan. The other type of loan is the practice purchase. So this would be a practice purchase loan. So again, it's going to be a fixed rate and a fixed term, anywhere between 10 to 15 years. The difference between this type of loan is we can do 6 months of interest-only payments. And the reason why you would want 6 months of interest-only payments in a practice purchase is, one, it could take you some time to get credentialed. You might not be able to get those insurance payments right away after you take over. Or two, you might not be purchasing the accounts receivable in the practice. So day one that you take over, all of those procedures that the previous owner has done, they're going to still be able to collect on those accounts receivable even after they've sold the practice. And day one, you're going to start from scratch from all these patients and all these insurance claims that you're making. It's going to take some time for those to come in. So we allow up to 6 months of interest-only payments. So again, you don't have to make such a large loan payment in that first couple-month period after you take over the practice. You don't have to do the interest-only if you don't want to, but that is there as an option for you. And then I want to talk about, so let's talk about what a conventional loan is versus what an SBA loan is. So A conventional loan is basically a loan that's directly from the bank or Bank of America that you're doing your loan with. So this is typically going to be a low fixed rate, a low amount of loan fees. Also, they offer up to 100% financing, so with no money down required. Like we talked about on a practice loan, you can do a 10 to a 15-year term. On the real estate loans, you can do a 10 to a 20-year term. We offer startups, practice purchases, real estate equipment. This is generally going to be a faster process for the loan. There's less paperwork involved. And again, this is a loan that's directly from Bank of America. We typically try to always do conventional loans if possible, but we do have SBA as a backup. So what an SBA loan is typically it's going to be a higher rate with a potentially either a fixed rate or a variable rate. Typically, it's going to be higher loan fees, and usually they're going to want 10% down as a down payment required. They offer the same, pretty similar terms, 10 to a 15-year term on the practice, 10 to 25-year term on the real estate. These type of loans are generally used when you're not able to, one, qualify for a conventional loan, or you're trying to qualify for a loan that's not covered under conventional financing. So for example, if you're doing a ground up construction where you're buying land and you're building a building from scratch, that's usually going to be covered under SBA loans only. Or maybe you were looking to start a practice and you're also wanting to buy the building at the same time. That's generally covered under SBA as well. Typically, conventional loans don't cover real estate purchases if you're starting a practice. They would only cover if you're already an established practice or looking to buy into a practice or something. This is where we talked about the collateral before. So typically on SBA, depending on what type of loan you're doing and the type of loan amount, they do require additional collateral outside of the practice. So sometimes in SBA, when you're doing a big real estate loan like ground up construction, they will take liens against your personal residence or personal collateral outside of just the practice and building itself. They do have more leniency when it comes to the cash flow requirements. So instead of that 1.2 ratio, that debt to income ratio we talked about, SBA might be like 1.15 ratio, so a little bit lower on the debt to income ratio. And this is partially going to be a loan that's from the bank as well as a loan from the SBA. So both of them work together on these type of loans. And then finally, what I want to talk about is purchasing real estate. So this would be owner-occupied real estate. And owner-occupied real estate is basically if you occupy 30% or more on a conventional loan or 51% or more on an SBA loan. So there's typically the three types of loans that we would offer. So the first one is 20% down. This would be for either a practice purchase or an established practice. Again, 30% occupancy or more. Typically, this would be a 20-year fixed term. So there's no variable rates, no balloon payments. And this is conventional loan. So this would be a loan directly from the bank. So we would finance 80%. You would pay 20% down. The second option would be, again, if you're looking to start a practice and buy real estate or do ground up construction, SBA requires 10% down, 51% occupancy in the building, 51% or more. And then this would be a 25-year fixed term. So a little bit longer term. So those monthly payments are a little bit lower, but this does require 10% down and 51% or more occupancy. Like we talked about, SBA loans are typically a little bit more fees and a little bit higher rates. And then the third option would be if you are an established practice and you occupy 30% or more, we can offer up to 100% financing on the building purchase with no money down. The only restriction on this type of loan is it's a 15-year fixed term. So we can't amortize it over 20 or 25 years. So it's a little bit higher payment, but you're going to have less, you're essentially no money out of pocket. So you could take that cash and go invest it in something else. And this would be a conventional loan that's directly from the bank. So I know that was quick, but just kind of want to cover some brief topics and everything. So this is recorded. I will be on the recording. So if you guys have any questions, feel free to put them in the chat. I'll be happy to answer them. Or we'll also put my contact information in the chat. You can reach me via phone or email, and I'd be happy to help. Thanks so much for having me on.